Hello friends, welcome to Letstute Accountancy. We have already discussed the meaning and importance of preparing a cash flow statement, the three important activities in which all cash flows are classified, and in our previous session, we got a deeper understanding of how the direct method is used to prepare a cash flow statement along with an example. So, if you may have missed those sessions, please do check that out first to get a better understanding of this entire topic and of what will be covered in today's session. In today's session, we are going to learn about the indirect method of preparing a cash flow statement, which is very important and widely used by business organizations. But before we start, I would urge you to visit our website www.letstute.com to check out the variety of courses available at super affordable prices. So don't miss out on that. And also do subscribe to our channel and hit the bell icon to never miss an update from us. Now let's begin with today's session. Friends, as we have discussed earlier, there are two methods for deriving cash flow from operating activities. The first one is the direct method, which we covered in detail in our last session. And the second one is the indirect method, which we will discuss more in depth today. Friends, under the indirect method of preparing a cash flow statement, the cash flows from operating activities are not shown directly from sales, purchases, payments to employees, payment made for expenses, etc. But indirectly, it starts with net profit or net loss before tax. Here, the net profit or loss refers to the profit or loss as shown by the profit and loss statement or the P&L statement. The profit and loss would have been calculated on an accrual basis, having non-operating and non-cash items of income and expenses also, right? So, in this method, to find out cash flows from operating activities, the profit shown by the P&L statement has to be adjusted for non-cash items like depreciation, fictitious assets written off, and etc., and also adjusted for non-operating items like interest on investment, interest on bank loan, debentures, etc. So, after this, we can find out what is the actual amount of cash inflow and cash outflow during the year from operating activities. Also, over here, we can adjust changes in the working capital, which refers to increase and decrease in the balance of current assets and current liabilities. So, here a question may arise. Is there any relationship between current assets and current liabilities with cash inflow and cash outflow? The answer is yes, there is. Let's understand this with the help of an example. Here we have debtors of 50,000 at the start of the financial year. If we assume that this year the company has made 100% of its sales on a cash basis, that means there would be no new debtors in the current year. And now at the end of the year, we have only debtors of 10,000 remaining. So we can say that 40,000 has been collected from debtors, and this is a kind of cash inflow transaction as cash is coming into the business. Even if there are credit sales in the year, that figure of sales would be included in our net profit figure, which is our starting point in the indirect method. By giving the effects for opening and closing debtors, we ultimately adjust for cash collection from debtors. So we can say a decrease in current assets leads to an increase in cash flow. In other words, cash inflows. Conversely, there could also be cash outflows. In other words, an increase in current assets leading to a decrease in the cash flow. Say for example, inventories. An increase in the balance of inventories at the end of the year compared to the opening balance is a result of a purchase of more stock, which has not been sold yet. So this leads to more cash outflows. Let's understand this with an example pertaining to current liabilities. Here we have creditors of 50,000 at the start of the year, and if we assume that the company has made all its purchases on a cash basis, then there would be no new creditors in the business. So at the end of the year, if we have creditors of only 10,000, that means the creditors have been paid in cash, and this is a kind of cash outflow transaction. Even if there would have been credit purchases, which would be included as an expense in net profit by looking at the differences between opening and closing creditors, we derive at actual cash payments made to creditors. which is our ultimate aim in the preparation of a cash flow statement. And the reverse of this would be an inflow of cash with an increase in current liabilities. So say if creditors' balance would have increased, that means they are not paid, and this will result in indirect savings of cash, which is considered as a cash inflow. And this adjustment will also help us in deriving the amount of cash payments made to creditors. So this is the basic rule which we have to keep in mind. If we talk about current assets, the rule is cash flow decreases with an increase in current assets, and cash flow increases with a decrease in current assets. And if we talk about current liabilities, the cash flow increases with an increase in current liabilities, and cash flow decreases with a decrease in current liabilities. And over here, do note that we need to consider current assets and current liabilities only related to the operating activities. So any accrued income or expenses for non-operating items would have to be adjusted with their respective items under the investing and financing activities heading. We shall understand all this in greater detail by solving an example towards the end of this session, and all the concepts we have covered so far will be reinforced through our subsequent problem-solving sessions. Let's understand the indirect method of how a cash flow statement works and how it is prepared. Firstly, we need to take the figure of net profit or net loss as shown by the income statement or the P&L statement. Here we can take net profit before tax and extraordinary items, then make the adjustments for non-cash and non-operating items. So we need to add back non-cash expenses and deduct non-cash income. For example, depreciation is a non-cash expense, so we will add this back. Miscellaneous expenditure written off or goodwill written off are also examples of non-cash expenses, so we will add them back. A loss on the sale of an asset will be added, and a profit on the sale of an asset will be deducted. Also, do note here that if net profit after tax or after appropriation is taken at the starting point, then we would add back tax provisions and also add back any transfer to reserves made from appropriation, since both are non-cash items. Here we also adjust for non-operating items. In other words, we add back non-operating expenses and deduct non-operating income. For example, interest paid towards a bank loan is a financing activity, but this would have been shown as an expense in the P&L statement. So we add back this interest expense to the P&L balance under operating activities, and a cash outflow for the same will still be shown under the financing activities heading. Another example can be taken of interest on investment. Now, this income would be included in the P&L balance, but since it is related to the investing activities, we will deduct this from the P&L balance and show it as a cash inflow transaction under the investing activities heading. So, summarizing this, we can even say that non-cash items have no place under the cash flow statement, and non-operating items will be removed from operating activities and shown under their respective headings. In other words, in investing or financing activity headings. So friends, we hope that you all must have gained good clarity about this topic by now. Our ultimate aim is to find out cash flows from operating activities, as this is the first heading within the cash flow statement. After this stage, we will get operating profit before working capital changes. So now we need to place the effects of changes in working capital, in other words, pertaining to current assets and current liabilities. After completing the above steps, we will derive at the figure of cash generated from operations. After this, we need to deduct income tax paid during the year. And lastly, we adjust any extraordinary income receipt or expense payments as a separate line item, and we can get the figure of net cash flow from operating activities. After getting the results of net cash flow from operating activities, we need to record the transactions of cash flow from investing and financing activities. And ultimately, the net figure of the cash flows from all three activities will give us a final result as to whether there was a net increase or a net decrease in cash. This net increase or decrease in cash will be added or deducted, as the case may be, to the opening balance of cash and cash equivalents. to derive the cash and cash equivalents balance at the end of the period. Friends, here we need to note that with respect to cash flows arising from investing and financing activities, there is no difference in the use of either methods, the direct or the indirect method. In order to get a better understanding, let's take an example and prepare a cash flow statement using the indirect method. For your understanding, we have only given you the basic required information and not the entire income statement and balance sheet. Now, let's examine the process of deriving the solution. To derive net cash flow from operating activities, first, we need to take the figure of net profit before tax, which is 150,000 here. Then, the amount of net profit has to be adjusted for non-cash items to get the actual figures of cash inflows and outflows. Here, we have to add back the non-cash items in the balance of net profit. Here, the non-cash items would include goodwill written off, depreciation, preliminary expenses written off, loss in the sale of a plant, transfer to general reserve, proposed dividend, and provision for taxation. The total of all these non-cash items would be 132,000, which will be added back to the amount of net profit. After this step, we need to deduct the figure of profit on sale of an investment, which is 5,000, from the total of 282,000. After doing this step, we will get the figure of operating profit before changes in working capital, which is 277,000 here. After this, we need to give the effects of change in cash flows arising due to change in current assets and current liabilities of the business. In other words, working capital. The decrease in current assets and increase in current liabilities will have a positive impact on the cash flows. Here, decrease in the balance of stock, which is 12,000, and an increase in the balance of bank overdraft, which is 10,000, will lead to an increase in the cash flows of the firm of 22,000. Similarly, after this step, we have to deduct the increase in the balance of debtors, which is 20,000, and decrease in the balance of current creditors, which is 18,000, from the total of 299,000. After following these steps, finally we will get the figure of net cash flow from operating activities, which is 261,000. Now we need to post the entries of other transactions that come under cash flow from investing activities. As we can see in the solution, the cash inflow transaction of selling investments worth 50,000 will be recorded with a positive sign, and the cash outflow transaction of purchasing machinery worth 100,000 will be recorded with a negative sign under the heading of cash flow from investing activities. By summing up these two transactions which are related with cash flow from investing activities, we can get the figure of net cash flow from investing activities, which is negative 50,000. Now we can proceed with the last step of recording the transactions related to cash flow from financing activities. The cash inflow transaction of issuing preference shares amounting to 80,000 will be recorded with a positive sign, and the repayment of a loan amounting to 40,000 will be recorded with a negative sign. After summing up the transactions of issuing preference shares and the repayment of a loan, we can get the figure of net cash flow from financing activities, which in this case is 40,000. And finally, by summing up these activities, A, B, and C, we will derive the final answer using the indirect method of preparing a cash flow statement, which reflects whether there was a net increase or decrease in cash flows during the selected period, which in this case was a net increase of 251,000. So friends, with this, we can effectively wrap up today's session. We hope that the indirect method of preparing a cash flow statement has been made clear to you. From our next session onwards, we will learn how to solve practical problems pertaining to what we have covered about cash flow statements so far. So stay tuned with us. Do visit our website www.letstute.com, where many accountancy and other course content is made available at super affordable prices. If you liked this session, don't forget to like and share the video with your friends. Do subscribe to our channel and hit the bell icon to get an instant notification when we upload new videos. See you all in the next session. Till then, keep watching, keep learning. Thank you.